Hello and welcome to Portfolio Matters Weekly Update, week 84. Now, I'm recording this on Wednesday, the 7th of September, and I apologize once again for our disrupted summer schedule, but next week, normal service will resume. Before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, a bit of housekeeping before we get into it. The next pub night will be on Tuesday, the 27th of September, in a pub that remains open. Lots of pubs are suffering huge energy bills, so we'll see which ones survive. Anyway, hope to see you all there to drown your sorrows. Okay, news while I was away over the last 2 weeks. Well, first of all, we had the Jackson Hole Symposium, at which Jeremy Powell reiterated the Fed's intention to stay the course in the fight against inflation. And that has led to market expectations that rates will be higher for longer. And as we go through this, you'll see that there has been a big sell-off in bonds, which we will discuss, but I am slightly puzzled by. G7 has agreed to place a cap on Russian oil prices, the details of which are yet to be worked out, and I am skeptical will have any effect. The one effect it certainly has had is that Russia has now completely halted gas flows via the Nord Stream pipeline, and that will make Europe's energy crisis worse this winter. Now, in China, lockdowns continue in Chengdu and Wuhan. And as you'll see, Chinese PMIs are fading again, and the Chinese economy is struggling. In the EU, we had August inflation numbers, and they rose again to 9.1%. In the UK, we have a new act on stage in Clowntown, and Liz Truss is Prime Minister. I'm very worried. In their recent meeting, OPEC Plus agreed to cut production by 100,000 barrels a day in October, despite very high oil prices. Okay, moving on to economic data. And I'm going to go through all of this because I've been away for a couple of weeks. So we had US manufacturing PMIs, and they beat expectations. In July of 52.8, and they were unchanged in August, beating expectations of a small drop. Non-manufacturing PMIs, this is the ISM number, were resilient, again, beating expectations. In July is 55.1, in August 56.7, up, indicating the service sector bounced slightly in August, and that was very much against expectations and has led to a sell-off in the markets, particularly in bond markets, as markets are expecting now interest rates to remain higher for longer. However, the S&P Global Services PMI, which should be very similar to the ISM non-manufacturing PMI, paints a very different picture of the US economy. Its number was 47.3 in July, i.e., depicting a contracting US service economy. And in August, it fell sharply to 43.7. So there's a big gap opening up between the ISM and the S&P Global Services PMI figures. I'm puzzled by that. We also had US non-farm payrolls a couple of weeks ago now, and those were resilient. So expectations were for the US economy to create 310,000 jobs. It actually created 315,000. So the US jobs report was decent overall. The unemployment rate ticked up, though, to 3.7% because the participation rate ticked up. And that is good news. Workers are coming back into the jobs market. Hourly earnings beat expectations, but not by much, 5.2% year on year, so well below inflation, but no further rises. So US workers are seeing their real incomes fall, but wage inflation is not rising, and that is a good thing. In the UK, we had manufacturing PMIs, which continued to deteriorate. They beat expectations, but they depicted a manufacturing sector which was now in recession. The services PMI slowed sharply to 50.9, which was well below expectations, but is still just in expansion. We also had EU inflation numbers. The main CPI number hit expectations, a small rise from 8.9% in July to 9.1% in August, but core CPI continued to rise, beating expectations. Core CPI is now 4.3%. We also had manufacturing PMIs in Europe, which slightly missed expectations, coming in at 49.6. So European manufacturing is contracting. Services also missed expectations and came in at 49.8. So the EU economy is now in recession, according to the PMIs. In China, the manufacturing PMIs slumped to 49.5, although the services PMI was resilient, coming in at 55, slightly down on July, but massively beating expectations. So now some charts. Actually, before we get into the charts, I should say that I'm doing this on my own because Richard has a job on Wednesdays. So this is US non-farm payrolls. 315,000 jobs were created in August, and we have a special section coming up. The unemployment rate ticked up to 3.7%. Hourly wages did not increase. Manufacturing PMIs were resilient. Service PMIs bounced. Although the S&P Global Services PMI continued to deteriorate and is now well below 50. ISM non-manufacturing business activity bounced. So the ISM figures are consistent, showing a services sector which picked up in August, in direct contradiction to the S&P Global numbers. Good news, the service sector prices paid index is coming off. And so hopefully that should feed through to slower US inflation in the coming months. Non-manufacturing new orders bounced and employment picked up, which was good news. Although you'll notice the employment index is below 50. So it's showing that the services sector is not intending to add jobs currently. US initial jobless claims faded and has actually faded for the last few weeks. Now, how much of that is due to summer employment? We will see. Continuing jobless claims were flat. In the UK, manufacturing PMIs, very poor, falling sharply, and I struggle to see how this can improve going into the winter energy crisis. Services PMIs were better, but fading towards 50. EU manufacturing PMIs actually below 50, but the fall was not as sharp as I feared, given the energy crisis in the EU. Services PMIs also faded and are now below 50. This is EU inflation, which continued to rise, but at a slower pace. And as higher energy prices feed through into the economy, I would expect EU inflation to remain high or rise further. Core CPI continued to rise. In China, the manufacturing PMIs fell back below 50, although the service PMIs was resilient. So, in summary, the US economy continues to show resilience, and PMIs rose in August. And as we've discussed a few times, the US economy is best placed to survive the coming global recession because it's energy independent. In the EU and UK, the economies are slowly subsiding into recession as we approach the winter energy crisis. In China, renewed lockdowns are causing their economic bounce to fade. Okay, on to one chart. And I thought this was a great chart sent to us by our Discord member, Jaw It. Now, what it shows is the orange line is US truck tonnage. So it's the amount of goods sent around the US by truck. And the purple line is the S&P 500. Now, up to the pandemic, the two were highly correlated. But since then, they've diverged. So what that means is that the value of US equities has diverged from the volume of US goods consumption. Now, why should that happen? Well, there are three possible explanations. The first is a lower proportion of overall goods are being transported by truck. And frankly, I don't think there's any reason to expect that. The second reason is that there's been an increase in profit margins, so that for the same volume of goods and economic activity, companies are making more profit. And we know that to be partially true because of fiscal largesse during the pandemic, but that will fade as that largesse disappears. On that basis, you would expect the S&P 500 to return to the levels consistent with truck tonnage. The third reason is that the US economy could have shifted towards higher value services and away from manufactured goods, but there's no way that that shift could explain such a large divergence, because that shift is likely to be quite small. And the final and most likely explanation is that equities are just overvalued, and that gap will close. So thank you once again to Jaw It for sending us that. If you haven't already done so, please join the Discord. There's lots of useful information being shared on there. Okay, on to Inflation Watch. So the only new numbers were for the EU for August, and their inflation rose to 9.1%. Now, this chart shows inflation rates across Europe, and there is an enormous divergence between inflation at 23% in Estonia. And a reminder, the Baltic states are most exposed to the energy crisis because they are the most reliant on Russian energy. And so that's at one end. Or Norway, which is energy independent, which has inflation of only 7.3%. Now, the ECB has the problem of setting a single monetary policy for a Eurozone economy in which there is massive divergence in inflation between 23.2% at the top and 6.8% in France. What are they going to do? And if you look at the causes of the increase in European inflation, it is because inflation is broadening and spreading to services. Now, as we've talked about previously, when an inflation shock hits, it takes time to feed through. So what you tend to see is inflation broadening and becoming more persistent. particularly as workers start demanding higher wages to compensate them for higher living costs. So the ECB is now forecast to start reacting finally to higher EU inflation. And next week at the ECB meeting, the market is expecting them to raise interest rates by 0.75%. In the US, the good news is that the ISM Manufacturing Prices Paid Index has fallen sharply. And so hopefully goods inflation will now start to ease. And that should bring inflation down. And you see, historically, there has been a strong correlation between the ISM Prices Paid Index lagged by 3 months and CPI. And part of the reason that the Prices Paid Index is falling is that supply chain pressures are easing, and this is the global container freight index, which shows that freight prices have halved since their pandemic highs. So you're getting deflation in global container shipping rates. But US consumers still have massive excess savings from the pandemic fiscal stimulus, so they can use that to support expenditure. And that means that the Fed will have to raise interest rates further to drive the US economy into recession, to slow it down, to control inflation. And at Jackson Hole, Jerome Powell essentially committed to doing so. So that means interest rates are likely to rise further for longer, and that would be very bad for equity markets. So equities are going to struggle in the face of higher interest rates. In Germany, however, that is not the case. The Germans have now used up all their excess savings from the pandemic. So in the Eurozone, inflation is not due to excess demand. It is due to a supply shock, an energy supply shock. In the UK, I thought this was very interesting. So this is from a website that looks at all the UK supermarket prices. And it shows that actually over the course of the last year, a basket of groceries in the UK the price has only increased by 3.8%, which is actually much lower than headline inflation, which is great news for consumers. But if you break it down, food inflation is much higher. It's about 9.3%, whereas non-goods inflation, so we're talking about shampoos and cleaning products, is much lower. The price of gin actually fell. So in summary, US goods inflation is now declining, and hopefully the peak in US inflation is approaching. In the UK and EU, inflation is being exacerbated by currency movements. As sterling and the euro fall, so the price of imported goods rises, particularly energy, and that means inflation gets worse. And in the UK and across Europe, we are seeing demands for higher wages. And if those demands are met, then inflation will be higher and more persistent. So as yet, in Europe and the UK, there is little sign of inflation peaking. And monetary policy remains very loose. We have the ECB and the Bank of England meetings coming up towards the end of this month. The ECB meets next week. The Bank of England and the Fed meet towards the end of the month, and market is expecting all of them to raise rates. Okay, on to recession watch. Now, the US housing market is slowing just as a load of new inventory is hitting the market. And all that should lead to sharp falls in US house prices. So the red line here is sales of new one family houses, and that's on the right hand axis, and you see that's falling sharply. And the black line is homes under construction. Reminder, the housing market leads the economy. And if you want one chart to predict the US business cycle, this is it. So the orange line is the National Association of House Builders Housing Index inverted. So rising line is worse. And the blue line is the unemployment rate, lagged by 12 months. And what you'll see is as the housing market slows, and it's slowing sharply now, so unemployment rises with a lag. The main reason that the US housing market is slowing sharply is that housing is just unaffordable. We're seeing rising mortgage rates as bond yields rise. And over the past year, we've seen a 20% rise in US house prices. And the combination of the two is just fatal. US mortgage payments adjusted for inflation are now higher than their pre-GFC peak. And the US Conference Board index is now falling to a point that indicates a coming recession. Now, it's not perfect. If you look back, there are times when it would seem to indicate that the US economy is going to go into recession, but then bounces sharply and the US economy doesn't go into recession. So we'll just have to wait and see. But the US housing market is very much showing that the US economy is likely to go into recession. And on Macro Voices this week, we had somebody who just looks at economic cycles, and their leading indicators, short, medium, and long term, all indicated that the US was going to go into recession, although the coincident indicator at the bottom indicates that it has not yet done so. And US household net worth is falling as house prices fall and the S&P 500 falls. So the wealth effect is now likely to turn negative, exacerbating in recessionary pressures. Global PMIs are ugly. So on the left, we have world manufacturing surveys, and those are falling sharply. But the good news is that pricing pressures also seem to be falling sharply, and that should mean that the peak in inflation is approaching. If we look further at manufacturing PMIs, the trend is not very encouraging. It's not just that the PMIs are falling, but they are falling very quickly. Export orders are falling across the world. And in the EU, these are real wages. And you'll see they're all very negative. That is going to cause a decline in discretionary expenditure, making a recession unavoidable. And if we look at US trade, then freight volumes are collapsing, which would seem to indicate that demand is collapsing and that companies are working through high inventory levels and cutting manufacturing orders. All of that is consistent with a global manufacturing slowdown. Now, I think this is a really important and useful graphic, and pause, take a look. So what this shows is how different indicators lead and lag a US recession. And so the first indicator to slow down is housing. Housing tends to slow down well in advance of recession, up to 2 years before recession. The next economic variable you would expect to see slow down prior to recession is new orders. And we are seeing new orders slow, although in the US, they bounced slightly this month. Then you'd expect to see profits slow. Now, in the US, corporate profits are already falling, but they're falling from artificially elevated pandemic levels and have just fallen back towards normal. Now, if they continue to fall, that is a recessionary indicator. And finally, employment falls, but employment tends to fall after a recession has already started. So we get a lot of discussion about how we can't possibly have a recession currently because we've got jobs growth in the US. Well, that's sadly not the case. If you look at the 1970s, when we last had an energy-induced recession, in all three recessions in the 1970s, employment continued to rise for up to a year after the start of the recession. So in summary, the global economy is slowing and all the leading indicators are turning down, but we're not yet in a recession. Okay, on to the European Energy Crisis Watch. And so the big news over the past couple of weeks is that Russia has now completely halted gas flows through the Nord Stream pipeline, making Europe's winter energy crisis worse. And Goldman Sachs are forecasting that will cause German energy bills to rise by around 250% between 2021, prior to the energy crisis, and 2023. Now, all these charts ignore government relief schemes. And over the next couple of months, we expect all European governments to announce schemes to cushion consumers and small businesses from the impact of rising energy prices. And we'll report those schemes and their side effects as they're announced. But in Europe, the bottom line is that they won't have enough energy to get through the winter. They need to cut consumption. And if you support domestic demand by putting a price cap or subsidizing domestic energy use, then that means there's less energy available to industry. And the prices that industry faces will be higher, and which will lead to a sharper recession. Now, Europe is actually being very successful about refilling its gas storage. And having started the summer season with gas storage levels below their seasonal average, it has now recovered to being above the seasonal average. And EU gas storage levels are on track to essentially be full by the start of winter. But that will not prevent an energy crisis this winter. Now last weekly, we can change this chart. Pause, have a look. Essentially, there is not enough European gas storage to provide for normal gas consumption throughout the winter. In Germany, the calculation is that in order to get through the winter without running out, the country will have to cut consumption by around 25%. And if the German government acts to support domestic consumption, that means that industry will have to cut harder. When we talk about the impact on European economies, Goldman Sachs are forecasting that the increase in energy costs by 2023 for the EU will be around 2 trillion euros, i.e. 15% of GDP. which will have enormous economic impacts. A lot of EU industry will simply have to close down. Make UK, which represents UK manufacturers, has warned that over half its members have received energy bills which have doubled. 13% have reduced working hours, and 7% have halted production for longer periods. They're warning that 60% of UK manufacturing businesses are in danger of failing. And this is the energy bill of a pub, the Rose and Crown in the Bebington on the Wirral. And they are now being quoted £62,000 a year. Now, we don't know what their previous bill is. Now, they're saying that they previously were paying 15p per unit. It wasn't quite clear what per unit meant, but the unit rate quoted on this gas bill is 97p. So does that mean their bill has gone up sixfold? Lots of small service sector businesses will not survive the winter if they have to pay this sort of energy bill. And hence, when it comes to organizing the drinks on the 27th of September, let's play it by ear. In the EU, this is the energy bill that was put on Twitter by a small German bakery. And previous monthly energy bill was 720 euros. From the 1st of October, that has almost quadrupled to 2,600. And this is from this morning on Twitter. A German toilet roll producer, Hackler, has filed for bankruptcy due to high energy and pulp prices. We're going to see a swathe of small manufacturing businesses close down. Now, when energy prices fall, they could well come back. But in the meantime, we're going to see a big recession. This is from the FT, and it shows electricity prices across Europe. And the UK currently has the highest. We await details of Liz Truss's package to cushion consumers and businesses from rising energy bills, and we hope to do something on that next week. But bottom line is, it's going to be bad. So in conclusion, the UK will have enough energy to meet its needs this winter if it can pay for it. We have 3 LNG regasification terminals. We should not have a problem with gas supply. The EU, however, particularly Germany, does not have those regasification terminals and is likely to fall short. It's likely to run out of energy by the end of the winter unless it cuts consumption. In all cases, we're waiting to see how governments react and what they do to cushion consumers and, in the case of Germany, either redistribute or ration energy to get them through the winter. So investment implications, well, despite the falls in sterling and the euro against the US dollar, I see no reason why that shouldn't continue, particularly as US interest rates remain much higher than European ones. And the US economy is just much better placed to weather the energy crisis. So I remain very long the US dollar. Okay, on to the US jobs report. Well, it was a decent report. 315,000 jobs created. And when you dig into the detail, despite the slowdown in the US housing sector, the economy still created 16,000 construction jobs. which is encouraging. Participation rate improved, which is great. The number of people who were part-time for economic reasons was essentially unchanged, and the labor market remains very tight. Unemployment remains close to historic lows. That means the Fed is going to have to tighten interest rates to slow the economy and get inflation under control. Now, we talked previously about how temporary workers are a good leading indicator because they are the easiest people for companies to fire. And again, the data is showing a resilient US economy. Companies are not yet shedding temporary workers. However, digging down further into the jobs report, there were some concerning details. So full-time employment actually fell by 242,000 workers, as did hours worked. Average weekly income growth was 0, which we have reported. So annual wage growth was unchanged from last month, which is good news. One detail of the jobs report is that it just looks at the total number of jobs created. What appears to be happening is because of the cost of living crisis, lots of workers are taking multiple jobs. So multiple job holders increased by 114,000. So overall, it was another decent US jobs report, although, of course, the jobs market is a lagging indicator, as we have discussed. Now, on to the outlook for sterling. And sterling has had an absolutely terrible year. It started 2022 above 135. It is now, it's actually fallen again today. It's now around 115. So, what's going on? Will that continue? Now, the first thing to point out is that relative to the euro, it's actually held up incredibly well. So this is not actually a sterling-specific problem. It's caused by the strength of the dollar and the pan-European energy crisis. And that energy crisis is causing a terms of trade shock. So what does that mean? Well, the terms of trade looks at what the relative prices of our imports and our exports are. So the price of our exports has not changed, but the price of our imports has massively increased. So our terms of trade have deteriorated. We need to export more to buy the same quantity of imports, and we are failing to do so. So if you look at our trade balance, it's terrible. The goods trade balance is very poor. We're talking about now a current account imbalance of 8% of GDP. And the UK is a net energy importer. And this shows you, and the chart on the left shows the value of our imports and exports in energy products to the EU and the rest of the world. And you'll see the cost of our gas imports and our oil imports has massively shot up this year, leading to a deterioration in our balance of payments. So all that is leading to higher inflation. And this is the latest Bank of England forecasts. This changes all the time with the cost of energy. But the UK base rate is currently 1.75%, and the Bank of England is forecasting that UK inflation will peak at above 13% later this year. So for international investors, UK assets are yielding very strongly negative returns. And in order to fund our imports, we need foreign investors to be buying UK financial and physical assets. The fear is that international investors lose confidence in the UK and they start demanding higher yields to buy UK assets. And that would mean further falls in sterling. Now, and I thought this was interesting. There's been a lot of discussion on Twitter about how the UK is in a potentially very poor situation, particularly if Liz Truss cuts corporate tax rates and exacerbates an already large fiscal deficit. So in summary, the UK is running an enormous trade deficit of around 8% of GDP due to a terms of trade shock in which the cost of its energy imports have exploded higher. And what happens next is dependent on the new Prime Minister, Liz Truss, and what she does to the UK fiscal deficit. And the early indications are that she will commit to spending 130 billion to subsidize UK domestic energy bills. But the impact on sterling will depend on the details of that scheme. And we will try to cover that in our next weekly when hopefully we have a few more details. She has not discussed whether she will actually go through on her campaign promises of cutting corporate tax rates. So the investment implications are that although sterling has already fallen a long way, the causes of the fall in sterling remain in place. And in the short term, at least, there's little reason to believe that sterling has bottomed. So regular viewers will know I have already moved almost all my assets out of sterling into US dollars. And so I have no intention of moving them back yet. I think this could get a lot worse before it gets better. And on to other charts. Now, in the US, the Fed has started QT, and starting from the 1st of September, QT doubled to 95 billion a month. So that will further tighten US monetary policy. So equities are fighting higher interest rates, but also QT. I think equities are going to struggle. I thought this was a very interesting chart. Now, this is how industrial production reacted to the oil crisis of the 1970s. So the yellow line that I've put in is October 1973, when OPEC announced its embargo on oil exports to the West. And what you'll see is that industrial production fell sharply, but only about a year later. So a lot of companies will have fixed their fuel bills for a year in advance, and it is only when those deals start to roll off that they face the reality of higher energy bills. At that point, they have to curb production or go bust, and expect the same to happen this time. Meanwhile, in China, lockdowns are getting worse. The top bar is the lockdowns, the number of days in lockdowns in 2021 for China's biggest cities. And you'll see this year, the biggest cities have been locked down for longer. And this chart will be getting worse and worse as Chengdu has now locked down. All that is not good for the Chinese economy. And this is a chart showing the decline in Chinese property developers' sales year on year for each property developer relative to last year. And you'll see none of them have grown sales. And China Evergrande, the biggest property developer, has seen its sales slump by 93%. That's leading to a fall in construction activity, which leads through to a fall in cement production as the property developers struggle. So the slowdown in the property sector can be expected to lead to a financial crisis, just as it did in the West during the Great Financial Crisis. Essentially, consumers buy properties with a great deal of debt, with mortgages, and as house prices fall, people get into difficulties, they default, and that means they default on their mortgages, and that leads to stress in the banking system. And we're now seeing 2 Chinese local banks go bust. Watch this space. In the UK consumers are struggling with the cost of living crisis, and they're turning to their credit cards. And so credit card borrowing is now growing strongly, and that means financial problems in the future. Okay, and onto the checklist. So all these numbers are for the last 2.5 weeks. So the change is from when we last reported 2.5 weeks ago. So over that period, the all share is down 4.4%, Stocks Europe down 6.6%, S&P 500 down 8.8%, the Nasdaq down 11%. So global equities have had a very poor run. So in our last weekly, we were discussing how the strong rise in equities over the previous few weeks was very likely to have been just a bear market bounce, and we were absolutely right. Equities have since rolled over. Bitcoin is deflating at a rapid pace, down 15% over the last 2.5 weeks, down almost 60% on the year. And both sterling and euro have fallen quite heavily against the dollar, which has risen sharply. The dollar is up 15% on the year. So some charts. So this is the dollar index rising relentlessly, and that is going to place a lot of stress on emerging market countries which have borrowed in dollars, and we are expecting more emerging market crises such as the one in Sri Lanka. Watch this space. This is the S&P 500. Well, the bear market bounce was just that and is well and truly over. So 99% of S&P 500 companies have now reported their Q2 earnings, and overall earnings are down 12% year on year. As we have discussed since the start of the year, margins were unsustainably high, and they're now reverting towards more normal levels. Now, we're expecting the US to go into recession and earnings to contract yet further from here. So this is profit margins and the returning towards more normal levels. But the average is 8.5%. So there's still a way to go. Reminder, we previously did a special on accounting identities and how fiscal deficits equal corporate profits. So as the US has been reducing its fiscal deficit, so that must equate to a fall in corporate profits, and that's what's happening. And in the year to date, the performance of the S&P 500 is its 4th worst since records began in 1922. Although, if you look at this table, you see in the majority of cases, the equity market tended to recover going into the end of the year, although there were exceptions, notable exceptions, in 1937, where it got a lot worse, and in 2008, when we had the great financial crisis. And the 60-40 equity bond portfolio is at its worst year since records began in 1976. So investors have struggled to maintain the nominal value of their savings, even as inflation rips higher. Normally, when the equity markets do badly, the Fed responds by cutting rates, and that cuts short the bear market and equities recover. This time, that ain't happening. The Fed is committed to getting inflation under control, and as Jerome Powell stated at the Jackson Hole Symposium, it was going to stay the course and keep on raising interest rates. So equity markets have big headwinds. Now, this is a very interesting chart, and please pause, take a look, read the text at the bottom. So what they've done is they have separated the S&P 500 performance into periods in which the economy was either overheating, had strong growth and low inflation, or slow growth and low inflation, or finally stagflation, which they define as having GDP growth below trend, as it is now, and inflation more than 1% above trend, as it is now. So, according to that definition, we are currently in the stagflationary period. And historically, if you look at the table bottom right, during periods of stagflation, the S&P 500 tends to decline by 7.3% per annum, and stagflation is the only period in which the S&P 500 tends to fall. So the historic omens are not good for equities. And to add to our worries, equities are heading into the most dangerous time of the year. Okay, on to commodities and energy commodities. And it was a generally bad couple of weeks. So Brent was down 5%, as was WTI. Dutch natural gas futures fell 1.4% over the period. UK natural gas futures down 7%. US natural gas futures down 11%. And those bold numbers disguise some volatility. So European natural gas futures came off sharply, but then have bounced as Putin has cut gas flows entirely through Nord Stream. Coal, however, grinds relentlessly higher, up a further 9% over the last couple of weeks. Uranium joined in, is up 6%, as Japan announced that it was going to restart its nuclear power stations, which it had closed down after the Fukushima nuclear disaster a few years ago. On to data specific to the oil market. Well, over the last couple of weeks, total US inventories, including the SPR, have drawn down by almost 10 million barrels. So the US is using more oil than it can either produce or import, and that is bullish. However, private inventories rose by 1.1 million barrels over the period, so releases from the SPR were enough to fully satisfy US oil demand. Total US crude production was flat at 12.1 million barrels, and that is only up 300,000 barrels on the year. So the global swing producer, the US, is failing to increase production. The Baker Hughes rig count, very disappointing, fell 5 to 596 and is only up 114 on the year. So US oil drillers are really not responding to the price signal and not getting back to work to anywhere near the extent needed to boost US oil production. So this is the crude chart, and that is not looking very happy. It is drifting off. Dutch natural gas futures having shot to an unsustainable high, now appear to be settling. These still look extraordinarily elevated and will cause a huge drag on European economic activity. Let's see where they settle in the coming weeks. And this chart shows the sources of European LNG imports. You'll see, compared to its pre-pandemic peaks, LNG imports have risen sharply, although perhaps not as much as I would have expected. These are UK natural gas futures. US has drifted off. Coal, though, grinds relentlessly higher. Uranium spiked on the news of Japan restarting its nuclear reactors, but that is in the future, and right now the spike is drifting off again. Okay, on to industrial commodities, and generally very poor. So aluminium down 6.3%. Cobalt went against the trend and actually bounced 5%, but is down 26% on the year. Neodymium was one of the big outliers, falling 18% over the past couple of weeks, and tin fell 14%. So generally, industrial commodities very weak. And that is precisely the pattern you would expect if global manufacturing is slowing down, and also the Chinese construction sector. So this is the aluminium chart, grinding relentlessly lower despite curtailments in production due to high energy costs in the EU. There's cobalt, had a bit of a bounce, but well off highs. Copper, Dr. Copper is diagnosing a sick world economy. Chromium coming off. Iron ore also drifting steadily down. China is a big consumer of iron ore in the construction sector, and weak construction equals weak iron prices. Lithium, however, remains very strong, and there appears to be a lithium shortage caused by drought in China. Neodymium prices fallen a long way. Nickel has completely unwound its earliest spike due to the shenanigans at the LME earlier in the year. Tin drifting off. Ferrovanadium has completely unwound its own slightly mystifying spike earlier in the year. Zinc coming off. On to precious metals. Well, another very disappointing couple of weeks. Gold continued to drift lower, and despite very elevated inflation, gold is down 7.1% on the year. Silver is down 22% on the year. Platinum down 11% on the year. Only rhodium and palladium are up. This is the gold price. Very, very disappointing. Not proving to be a hedge against monetary debasement or high inflation. Silver, likewise. Platinum drifting off. Rhodium has actually seems to have found a floor. Palladium, likewise. Finally, on to rates. And rates were the big surprise the last couple of weeks. Rates shot up. Now, I am surprised by the extent to which rates have moved. In part, the move can be explained by the Fed's insistence at Jackson Hole that it was going to stay the course and raise rates. But you would expect, as certainly in Europe, the European and UK economies start moving into recession, that inflation will come down, and therefore investors will start buying bonds. And actually, the opposite has occurred. There's been a sharp sell-off in UK and European bonds over the past couple of weeks. And so the UK 2-year rose by an amazing 68 basis points to 3.15%. The 50-year rose by 71 basis points to 3.16%. Remember, bond prices are the reciprocal of yield, so bond prices plummeted. In the EU periphery, Greek yields rose by 66 basis points to 4.2%, and Italian yields also rose by 61 basis points to 3.96%. At these levels, the Greek and Italian governments will be insolvent if those yields persist. Okay, so this is the UK 10-year. You'll see over the last couple of weeks, there's been an amazing spike. The 30-year, similar. When we went on holiday, it seemed that bond yields were steadily declining. And since then, they've spiked much higher unexpectedly. So if you compare the US 10-year and the UK 10-year, you'll see over the last couple of weeks, they have diverged strongly. UK gilt yields have risen much more than US ones. Is this a sign that investors are losing confidence in the UK as an investment destination and in the Bank of England's commitment to bringing down very high UK inflation? Now, I am puzzled by the increase in bond yields. If we look at the US, you'll see that after Jackson Hole, inflation expectations actually fell. So why are bond yields rising? Because that would imply that somehow the market is demanding higher real yields to hold US treasuries. So the sort of risk premium for holding bonds has risen. Why? On the Discord, I have shared a very interesting note by Florian Kronewitter, where this chart comes from, where he argues that that is due to liquidity. So the Fed is no longer buying US treasuries. In fact, it's selling them as part of QT. US banks have all the US bonds they need and are not buying more. So one of the side effects of US sanctions on Russia, in which it seized Russian FX reserves, is to make US treasuries less attractive to foreign governments. And so foreign governments have actually not been buying many US treasuries. Certainly, they've been buying them at a much lower rate. So all that means that the US is struggling to fund its enormous fiscal deficit. Okay, do I believe that? Not sure, frankly. Now, I don't have a better explanation. And I am puzzled by the rise in bond yields, which has personally cost me money. And this could yet get worse because I don't fully understand it. So regular viewers will know that I have positions in US long bonds, which I have trimmed. This is the German 10-year, which is also rising. Italian. And what is interesting is that Italian redenomination risk is rising again. Now, so what is that? Well, redenomination risk is the risk that your Italian bond, which is currently priced in euros, can be repaid in lira or in a different currency were Italy to fall out of the Eurozone. So different Italian bonds have different covenants, some of which prohibit repaying the bonds in new lira and demand that they are repaid in euros, and others don't. And so the difference in price between the two gives you the price for redenomination risk. So the market is once again worried that Italy may fall out of the Eurozone. There's a Greek 10-year rising back towards its highs. And reminder, global debt levels have been have relentlessly risen and are now at new all-time highs. And what that means is that the world economy is increasingly sensitive to rises in interest rates. So higher yields equals higher rates means borrowers have to pay more and existing debt holders have to pay higher interest, all of which means they spend more on interest payments and they have less to spend on discretionary items, and therefore that takes demand out of the economy and slows the economy down. So high interest rates, not good for already weak global economy. And finally, this is the seasonality chart for the S&P 500. We talked about this a bit earlier, but this period of the year is not good. Hold on to your hats. So finally, concluding comments. Well, the big news of the last couple of weeks is a strong sell-off in global bond markets. In the EU and the UK, that can perhaps be explained by the energy crisis leading to recessions and large trade imbalances and international investors demanding higher yields to hold UK and European assets, financial assets. In the US, it's more puzzling, and it could well be related to liquidity, in which case bond yields could yet rise further. Elsewhere, the US economy continues to show resilience, although leading indicators are continuing to deteriorate. The global economy is slowing, and a recession is moving steadily closer. Now, on to my own personal portfolio. Well, I had an indifferent couple of weeks. I was up 0.2%. The all share, though, had a poor period, down 4.4%. So over the last couple of weeks, I'm up 4.6% relative to the all share, and I'm up 22%, and I'm up almost 23% year to date. So I'm having a decent year. However, I've got things wrong. So regular viewers will know that I had allocated quite a large position to US long bonds, and the sell-off over the last couple of weeks has hurt. And frankly, I don't fully understand it. So earlier this week, I took a third of the position off at a loss. So despite being right on the direction of sterling, US bond prices fell more than the US dollar rose. So I actually lost money on that trade. So so on the third of the position that I closed, I lost 2.7%. I also closed my position in the 2071 gilt, and that was a total disaster. It was a very small position, only 2% of the portfolio, but it lost 30%. The sell-off accelerated over the last couple of weeks. Now, when I put the position on, I said that I was only doing 2% because I was unsure about it, and that a 2% position was enough to make me care. Well, next time I do that, I'll only be putting on 1% because, frankly, that hurt, even though it was a small position. And 2 weeks ago, before I went on holiday, in the weekly, I discussed how I was very unsure about this position because Liz Truss was going to come in. She was talking about cutting corporate tax rates, and that would lead to an increased fiscal deficit in the UK, which could undermine sterling, etc. And I was very worried about the position, but I failed to react and actually cut it. And so it fell badly in the last couple of weeks, and the whole thing's cost me money. Now, medium term, there are no bad assets. There are only bad prices. And reminder that the 2071 gilt last year peaked at £140. So it's more than halved since its highs. And if it were to retrace even a portion of that, then those are big potential returns. So if the 2071 gilt, for example, was just to return to the price at which I bought it, we are looking at the best part of a 50% return. So I'm still looking at this trade as a good potential trade going forward. But for now, I've closed out. Now, what did I buy? Well, I bought essentially more US dollar cash by buying the iShares US Treasury 1 to 3 year ETF. And that has done well for me. And that is the reason that despite my losses in long bonds, I was actually up over the last 2.5 weeks. And 75% of my portfolio is now in cash. The remainder is in the US long bond. So this is the tale of my disastrous dalliance with UK 2071 gilt. Now, using my rudimentary technical analysis skills, I thought it looked like the price was bottoming at this point here, late May. So I bought in 2% position. And then over the course of the last couple of weeks, when I've been away, it has absolutely collapsed. And I don't fully understand what's going on. Hence, I've completely cut this position and I have trimmed my position in the US long bond. In both cases, I fear that it could get worse before it gets better. So this is US Treasury bond 2051, i.e. 30 year. It's had a very bad couple of weeks. So this was my equity asset allocation as of Monday. I've now trimmed a third of my long bond position, and my position in US cash has essentially risen to 75%. I hold very few equities. I'm looking to buy gold when I think gold is bottomed, and that's not yet. Okay, that's it. Thank you all very much for watching. Next week, we will be back to normal service, and I hope to record on Friday with either Richard or Stuart. But this week, I'm afraid you've just had me. Please, can you press like and subscribe to the channel? And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.